Hello and welcome to our Q1 market update video, social distancing edition. So we cautioned in our fourth quarter commentary that market returns in 2019 were achieved largely on the back of stagnant earnings growth and that a tempering of expectations may be warranted as we headed into 2020. Of course, nobody could have predicted that just weeks later, the world would be in the midst of a global pandemic and that financial markets would have been thrown into a state of complete disarray. The rapidity with which markets retreated from their highs in response to the global spread of COVID-19 was extraordinary, even compared to other extremes in history. But to be fair, that's largely reflective of the suddenness and the magnitude of the uncertainty that the virus creates. And when you think about it, it's not necessarily the virus itself that's creating the uncertainty, but the response that's required to keep people safe. We have basically shut down portions of the global economy, and the consumer economy in particular. Things like retail, restaurants, travel, and leisure are no longer even an option right now. And that cuts right into the narrative that we've been expressing throughout much of the economic expansion, which was that the consumer was the strongest component of the US economy. So what now? Well, over the long term, markets are driven by fundamentals. Things like corporate earnings, GDP growth, and overall economic activity. But the entire concept of fundamentals has largely been tossed aside in the first quarter, because at this point in time, it's simply impossible to know what the economic activity is going to look like in the near future. Unfortunately, until the world is able to emerge on the other side of the curve, a clear understanding of market fundamentals will not be achievable, and volatility will continue to be the norm. However, in our view, it is vital that investors continue to remind themselves that the economic impacts of the COVID-19 pandemic will be transitory. In fact, there are a couple key considerations that we think should help to keep investors' fears at bay. First, and we've discussed this a bit in some of our weekly pieces, is that once the time finally arrives where we can begin shifting our focus from protecting the public health to revitalizing the economy, we will arrive at that point with a historically large amount of both fiscal and monetary stimulus supporting that effort. Congress just passed a $2 trillion economic relief package with potentially more to come, and the Federal Reserve has signaled that it is ready to throw the kitchen sink at this thing. The potentially immense impact of both of these policy initiatives enacted simultaneously should not be discounted. Secondly, and this is a little bit more subtle, but possibly just as important, is that the United States banking system is in much better shape than it was during the last economic crisis. Many investors are still scarred by the 2008 financial crisis, but while the banking system became the epicenter of the carnage in 2008, it's likely going to be an essential part of the solution this time around. And that's a major detail. Because if you think about it, in order for us to successfully navigate the economic challenges that lie ahead, it's going to be vital that the financial system continue operating at full capacity, extending lines of credit to otherwise strong businesses that are facing tremendous pressure as a result of the COVID-19 pandemic and the economic measures we're taking to quell the damage. The good news is that due to the stringent regulations that were put in place following the global financial crisis, banks come into this situation better capitalized than they have at pretty much any point in history, and they're well positioned to do their part. So while there is no sugarcoating the fact that the near-term future is going to be extremely difficult, we think it's important for investors to focus on the fact that we have come into this from a position of relative strength. And with the support of historically huge economic stimulus and a fundamentally healthy banking system, there's some reason for optimism, which frankly we all need right now. And that concludes our Q1 market update. Be sure to keep up with us through the weekly commentary for further updates from our team. We'll catch up with you this summer for an update on the second quarter. Stay safe and stay healthy.